And just to say that we're pleased to host our third event in the last 12 months with the iafe. Without further ado, I'd like to introduce tonight's host for the iafe, which is Mark Anderson from Hermes, and obviously a board member of the iafe also. Mark, welcome very much.
Thank you.
I will keep my remarks very brief so we can get this going quickly. First, I would like to thank Merrill Lynch again for hosting this event. It's a wonderful facility, and it's very nice and gracious of them to allow us to use it. Tonight, we're going to talk a bit about credit risk. In fact, we have a great authority, an expert on it. Jean-Paul Laurent is the professor of finance at the actuarial school at the University of Lyon. And I like this. He is a scientific consultant to BNP Paribas, where he focuses, not surprisingly, on credit and risk management issues. We will also have a moderator, Dr. Michel Crouy. He is currently the head and development of Excess Corporate and Investment Bank. He has overall worldwide bank responsibility for quantitative research and the development of new products and applications, supporting the trading and structuring business, where, of course, credit derivatives plays a great part. Now, I was speaking with Jean-Paul, and he says his presentation will take maybe up to about an hour, maybe a bit less, but he'd like to leave questions for the end, and then Dr. Michel will be the moderator for those questions. So when we get to the end of the presentation, I hope you have a lot of good questions to ask, because part of this is for your benefit to try and exchange information. So with that, I guess I'll invite both gentlemen up, Jean-Paul and Michel.
Very good, thank you. Good evening.
I'm delighted to be here tonight and to chair this event, and it's a real pleasure for me to introduce Jean-Paul Laurent. I think I've known Jean-Paul Laurent for many years, since he started to be interested in finance. At that time, there was no credit derivative, no CLOs, no CDOs, nothing of that sort. Right? And I should say that the quality of the work that Jean-Paul has produced over the years is quite impressive. Jean-Paul is obviously one of the pioneers in the field of credit risk modeling. He's produced significant contributions in this area. And the topic today is pretty new. I mean, there is not much in the literature on the hedging of correlation products, CDOs. So Jean-Paul is going to address this topic tonight. I think it's the first step in the process of developing a full-fledged model for hedging CLOs. We'll take questions at the end of the session. So the floor is yours.
Thank you, Michel. So there is a rather technical note that has been distributed at in the room, and my slides will be available both on my personal website and on the IFR website. So I've taken some risk, in some sense, by addressing this topic, the hedging of CDOs. And as we will see, that there is not so many work dedicated to this important issue. And while the note that you have in your hands is rather mathematical, my presentation will not be very technical. I try to give more focus on the ideas rather than the mathematics. There will be two parts in that presentation, and the main part will be a discussion and a survey of different issues related to the risk management of CDOs, and more precisely the default and credit spread risk. I will review the different models and the different approaches that we can think of, and at the end of the presentation I'll give the main result and the flavor of the technical paper that you have. So the first thing is that if you look at the literature relating to the pricing of CDO tranches, there is almost everything is dedicated to the pricing models, and there is almost no theoretical or practical investigation of hedging issues. This is a bit surprising because, as you all know, in derivatives markets, such as interest rate or equity derivatives markets, the pricing of a product is related usually to the cost of the hedge. And we have that idea of complete markets. And this is not the approach that has been used so far in credit markets. People rather have, let's say, some pricing measure and price, let's say, CDO tranches or first to default swaps under some risk neutral measure. And there is no clear connection between the pricing and the hedging. And there is a clear issue, and it's not only a theoretical issue, which is which business model should hold for investment banks with respect to the management of CDOs. Are we in a complete market framework? Can we think of hedging both default and credit spread risk? Which amount of risk should be dealt with reserves and so on? So the purpose of that talk will be, as I was mentioning before, firstly an overview of some issues in the risk management of CDO tranches. There are many pricing models, so in that sense the task is not that easy. And depending on the models, the emphasis will be put on some specific risk, as we will see further. The note that have been distributed provides a framework for the risk management of CDO tranches on rather large indices. If we think of the iTraxx or CDX indices, we have more than 100 names in these. So there is some kind of default risk diversification within the index itself. And in some sense, the paper is rather thought-provocative in the sense that while people tend to think of default risk first, it shows that we could rather concentrate on the dynamic hedging of credit spread risk and in some sense forget default risk, since default risk is statically hedged by diversification in a large portfolio. So this is more or less the agenda. I will briefly recall the main risks within CDO tranches and to try to see how credit spread and default risk are connected. I will take a very simple case study of arbitraging single name long CDS against a rollover of short maturity CDS. We'll also see another case study which is related to the hedging of a first to default swap based on two names, and we will see some issues related to the completeness of the market in that very simple example. Then, keeping on the review, I will look at the main credit risk models and see how risks, either credit spread or default risk, are modeled within these different models. And there are two main categories, the name per name models and the aggregate loss models. And we'll see how hedging occurs in these different models. So very obvious and simple things to start with. So default risk is related to jump of bond prices to recovery value at default time, and this will drive the CDO cash flows. So, for instance, if we look at an equity tranche, and if there are some defaults, it will lead to some payment on the default legs. One important issue will be the possibility of multiple or simultaneous defaults. if there are some simultaneous defaults, then it may be that the payments in the CDO tranches are much larger. So credit spread risk, as you all know, are changes in the bond prices prior to default that may be due to either shift in credit quality or in risk premiums. So this will rather change the mark-to-market of tranches. It obviously has some connection with future defaults in the sense that a rise in credit spreads will tend to increase the probability of future defaults. And within that realm of credit spread risk, there will be some different topics such as changes in the overall level of credit spreads, changes in the dispersion of credit spreads, or in the correlation between credit spreads. And lastly, I will not really discuss that issue. There is the topic of the recovery risk when recovery risk is stochastic. When recovery rates, is stochastic. So let us start with the first very simple case study and see how it might be interesting to dynamically use short-term credit swaps in order to hedge some other product. So it's a very, very simple example. It's a single name case, and the product to be hedged is simply a long-term default swap. And the idea is that we'll show that we can very simply transfer the default risk into some kind of credit spread risk. So the idea is to construct a portfolio where, let's say, we are short protection on long-term default swap, and we'll buy a series of short-term default swap on the same name. So let's consider a 5-year default swap on some BBB counterparty with, well, it's a very theoretical example, with a yearly premium of 50 BPs and recovery rate of 60%. When we have these exchanges of cash flows, and in case of default before the 5th year, we have that default payment of 60% in exchange of the yearly payment on the premium leg. So the idea is, I'm short protection on the 5-year default swap. So in order to hedge that default risk, I will start by buying a short-term default swap. Let's say a 1-year default swap. I assume that the premium is 33 BP, and I have these cash flows there up to the first year. At the end of during the first year, it can be seen that I'm perfectly hedged against default. But at the end of the first year, I have to rebuy a new short-term default swap in order to be fully hedged against default after the first year. So here there is a dynamic strategy where there is a rollover of short-term default swaps, but every year, up to a default date or up to the 5th year. But what can be seen is that if I look at the short-term default swap at the end of the first year, the new one where I'm going to buy protection, I do not know the premium that will be involved. So if I look at the overall cash flows, it can be seen that there is no more cash flow related to a default payment, but there is only an exchange of credit spreads. Basically, there is, for the point of view of a credit derivatives dealer, there is a payment of short-term credit spread every year up to the 5th year, and the credit derivatives dealer receives the long-term credit spread. There is a full one-to-one protection at default time. The previous strategy has eliminated default risk and recovery risks too, but there is, as we'll see immediately, there is a credit spread risk now, which is if short-term premiums increase, reflecting a lower credit quality of the name, and no default occurs before the 5th year, then the credit derivatives dealer is exposed to that increase in premiums. So there is some kind of negative carry then, and we can see that here we have a long position in long-term credit spreads versus a short position in short-term credit spreads. So this shows that some kind of interaction, rather complex interaction between default risk and credit spread risk. And here there is a rather simple possibility to hedge the default risk and transform it in credit spread risk, which is of smaller magnitude. Now let us turn to the second case study. So now we're going to consider multi-name credit derivative, and the simplest to address is the case of a first to default swap. So it could be seen as almost as a, if we think in terms of a CDO tranche, as a 0.1% CDO tranche, in the case where the recovery rate would be equal to 0. So if we are now dealing with multi-name credit derivatives, we need to consider the joint distribution of default times and to model accurately the dependence between default times. So to make things even simpler, we'll just restrict ourselves to the case of a basket out of two risky names. This can be generalized very easily. So if the first default times occurs before maturity, then the seller of protection will pay the non-recovered fraction of the defaulted bond. So that's the default leg of a contract. And I thereafter assume that the two bonds cannot default simultaneously, and we'll see why this assumption is critical. I will moreover assume that default on one bond has no effect on the credit spread of the remaining bond. So that is, there is no contagion effect. So if we look at the default leg of a first to default swap, the seller of protection, in order to be protected, there is only one way, which is to hold two single name credit default swap with the same nominal as the nominal of the bonds. This is there is a very simple hedging rule, and it's the only way to get protection at default time of a first to default. If we have, let's say, a smaller credit delta that is smaller than 1, then there will be only a partial protection at the first to default time. Here, the maturity of the underlying default swaps does not matter, provided that we have these credit default swaps at default time. So some notations, that T1, T2 will denote the default times of counterparty 1 and 2. HT is the available information default time. We know whether there is default or no default, for instance. P will denote the historical probability. Lambda 1 and lambda 2 will denote the risk neutral, the historical intensities. We should skip their risk neutral. I'll discuss thereafter the issue of risk neutral default intensities. So this just means that under this historical measure, the probability, the local probability to have some default provided there that we have no defaulted before is equal to lambda I dt. This here in my example will be assumed to be constant. So there is, if we think of some local independence between default events, then the probability of two names defaulting in between t and t plus dt is indeed t squared. So it means that that local independence is related to the assumption of no simultaneous defaults. So then, this is not mathematical, but I think it really gives the good intuition. we are now going to consider the edging of that first to default swap. And so we can see that in theory we have 4 possible states, depending whether name 1 or name 2 have defaulted or have not defaulted. But as we have just seen, under that local independence assumption, the probability of joint defaults can be neglected. So basically, the important thing is that if there are no simultaneous defaults, there are now only 3 possible states, which is rather good news, because as we will see in the next slide, there is the risk-free asset, and we have 2 underlyings, which is the credit default swap on name 1 and the credit default swap on name 2. So we are in a situation where we have as many edging instruments as the number of states of the world. So here we have the historical probabilities to be in the different states. For instance, name 1 defaulting, name 2 non-defaulting, the probability is equal to lambda 1 dt. None of the names defaulting, the probability is equal to 1 minus the sum of lambda 1 and lambda 2 dt. And it's rather easy to to derive, well, here with the probability of the different states by simple probability rules. So let us now look at the cash flows on the different edging instruments. And firstly, the CDS. So it may be that lambda 1, phi 1 is here the premium on the CDS on name 1. So let us remark that the premium may not be equal to the historical probability. So phi 1 is typically a risk premium and may be larger than 1 usually. And we have the same here if we look at the cash flows on the CDS on name 2. So, for instance, if we go back to name 1, if name 1 defaults and name 2 does not default, so we have a default payment on CDS 1, and here we have no default payment and we have just to pay the premium. So that's the, let's say, the stylized CDS contract. So here are the cash flows of the first to default swap. So we have basically a payment whether there is a default of name 1 or of name 2. And we have only the P sub F is the first to default premium. If we look at a portfolio where we hold 1 unit of CDS1 plus 1 unit of CDS2, so I've just summed up the cash flows there, it can be seen that we have these cash flows. And we can see that if we want to have no arbitrage opportunities, then we have the premium of the first to default swap that has to be equal to the sum of the premiums of the 2 CDS. So in this case, we can see that we can statically replicate the first to default swap by holding the 1 unit of CDS1 plus 1 unit of CDS2. And here the nice thing is that we have now, let's say, a replication price. The premium of a first to default swap is related to the premium of the underlying CDS through some idea of replication and edging. So I was mentioning there is the first critical issue, that is, I've precluded the possibility of multiple defaults. So if there were some multiple defaults, there would be a 4th state, and the market would be incomplete because I would have only 3 hedging instruments. We can also see it's really like the Cox-Ross-Rubinstein binomial tree. We can see that the probabilities that will be involved for computing prices will not be historical probabilities, but will be probabilities that will be extracted from the credit spreads. And we can see that if we use these probabilities and discount the payoff, we actually go back to the premium of the first to default swap. So I've already discussed the issue of simultaneous defaults. What in the case of contagion? So what if there are some jumps of credit spreads at default times? Here, so I'm going to skip the simultaneous default case. I think the issue of the jump of credit spreads is on the next slide. So what if there is some contingent effects? So usually, well, it may not be the case, but the most common case is that default of the first counterparty is rather bad news for the second. And if we use short-term default swap, since their duration is equal to 0, there is no capital gain at default. But if we were to use some longer single-name default swap, then let's say when name 1 defaults, and if we are long protection in name 2, then there will be a positive jump in the PV of the credit default swap of name 2. So if we use longer term default swap in order to hedge that first to default, thanks to that effect of a jump in the PV, we can reduce the amount of CDS in both names. But the point is that this kind of reduction of the credit delta is rather model dependent. So, since it's model dependent, we can think of going back to hedging the first to default swap with short-term credit default swaps. But now we have another issue. The other issue is that if we use short maturity CDS to hedge the first to default swap, so we buy protection on the underlying CDS, thanks to the short maturity of the CDS, at default times there is no jump in the PV of the CDS, but we need to roll over the hedging portfolio with the single name credit default swaps up to the first default time. And now we have a negative exposure to an increase in CDS spreads. Well, so it raises the issue of, once again, of in that multi-name framework of, can we think of defining precisely what is the cost of a perfect hedge? Is the perfect hedge feasible? Are we in complete credit markets, or are we rather in an incomplete market? Can we hedge both this default risk and credit spread risk altogether? Or are we to, for instance, to hedge just the credit spread risk and remain with some default risk, or hedge default risk and remain with some credit spread risk? So I think this is quite important because, for instance, if in the CDO market the traders are able to hedge the credit spread risk but not at the same time the default risk, they will need some reserve, and they will mean that the business model in some sense will be in between lending activity and a trading activity. So now we are going to see how, well, different popular models for multi-name credit derivatives. And so I'll firstly describe briefly the main features of these models, and we'll see how within this model, with different models, we can either hedge or not hedge certain categories of risk. So I will start with structural models. I will discuss intensity models, contention models, copula models, multivariate Poisson models, and eventually aggregate loss models. So the rather, let's say, interesting, at least from an economic point of view, the case of structural models. So the idea is well known, is we try to model the firm's asset, and the first usually default occurs at the first time passage below the critical thresholds for the firm's asset. It's similar to Rhine models in insurance theory. Then it can be seen that CDS appear as deep out-of-money options on the underlying asset. If we look at, in the multivariate case, let's say the joint distribution of defaults, there is a rather interesting and striking result, which is that when the asset dynamics are normal or log normal, then the results, the outcome of this model is very similar to the very famous standard one-factor Gaussian copula. So there is a paper by Padescu and White which shows that empirical evidence, and I'm currently working on some paper which explains why basically we could almost simplify the structural model with the copula model. So we could improve the model by introducing some stochastic volatility and so on, which leads to some numerical issues. There is a second category of models that are also known as shock models or multivariate Poisson models, where default indicators of different names are driven by a multivariate Poisson process. So there's a series of people that have been working on such models, and typically there are some common and idiosyncratic shocks. So common shock are Poisson processes that can drive defaults to a certain number of names. This common shock can be fatal or non-fatal. Typically, a fatal shock means that if there is a jump in that common component, then it will automatically lead to default of a name, whereas in a non-fatal shock, there is only some probability, below than 1, that there is default. So in these models, there are typically the possibility of multiple defaults, depending on the structure of the shocks and so on. And all the dependence between defaults is driven by these common shocks. There is a high degree thus of incompleteness, because as we've seen, multiple defaults leads to some kind of incompleteness, and especially, I'll discuss this later on, when we come back to the hedging issue. So for instance, in this kind of models, there's a possibility of some Armageddon risk. If there is some common shock that could wipe off all the names altogether, it means that if we introduce that kind of risk in the iTrax, that if such a shock occurs, then all the names within the index will default altogether, and thus it really leads to fat tails in the right of a loss distribution. The intensities in such models are rather strange, because they are deterministic and even constant in the simplest case between two shocks. So we have no any dynamics of credit spreads, if you wish, but all the dependence, once again, is related to the multiple defaults. So the famous intensity models. So here we have, as it was the case before, contrarily to structural models, default arrivals are not predictable. We can only think of the intensity, that is the local probability of a default. And usually, in these models, they preclude simultaneous defaults, because thanks to the local independence that I discussed in the first default case. So in the multivariate case, these models are known as multivariate Cox processes. There is a very important feature that is not only they preclude simultaneous defaults, but also there is no contagion in this kind of models. In intensity models, at least in the multivariate Cox process, credit spreads do not jump at default times. There is a second subcategory of intensity models that are contingent models. And when we start interacting intensities, so typical example being the model by Jarreau and Yu or by Yu, where the specification of a model starts with the specification of interacting intensities, and typically we have jumps of credit spreads of survival names at default times. So by construction, there is contagion in these models, while in the multivariate Cox process, we don't. Now the copula models. So here the starting point is to specify a copula of default times, and this will state the dependence between default times. Marginal default time distributions are self-calibrated onto credit spread curves, and we can look at within this model we can define some intensities, at least for smooth copulas, that are related to partial derivatives of a copula. There's a paper by I think Schonbucher and Schubert that precisely states the intensity dynamics within these models. So, because they involve high-order partial derivatives, the intensities may be difficult to compute. Typically, what we have is that default intensities are deterministic between two default times, and they jump at default times. So actually, though the premises of the model are different, the copula models belong to the category of contingent models. So there is a connection between the two approaches, though the starting points are different. So let us know how we can see the edging of a CDO tranche within these different approaches. Oh, I'm sorry. I was almost to forget the collective approach or the aggregate loss models. In all the models that I've discussed up to now, we start from let's say the name per name default probability. So these are called in the actual theory individual models. Then there is some kind of aggregation procedure that allows to, thanks to the various dependence properties, to derive the dynamic of the aggregate loss, let's say the I-Trax index or the CX index. So it's typically a bottom-up approach. There is a second category of models, which can be, in some sense, if we think in terms of equity derivatives model, I would say that is everyone, when considering an option on the S&P 100, for instance, will start with the dynamics of the index and not try to look at the dynamics of all the stocks, their local volatility, and looking at the copula between the individual stocks. So typically here, since CDO tranches can be seen or only involve European options on the aggregate loss, we could think of directly specifying the loss dynamics. It can be seen that the aggregate loss is, I'm going to detail that point, is a market point process. And so it seems in some sense a simpler approach, since we do not have to look at all the details within the portfolio, all the interactions, the complex interactions between the names. So it's the aggregate loss is constant and jumps with some positive jumps at default times. The aggregate loss intensity is simply the sum of default intensities, at least when there are no simultaneous defaults. And the magnitude of a jump is simply 1 minus the recovery of the defaulted name. So we could see the aggregate loss as a market point process, which is a rather familiar model for in probability theory. So we could think of either some Markovian model of the aggregate loss, like the Sidenius, Peterberg, and Andersen model, or the Schomburger model. To make things very simple, it's almost like a Markov chain process for the aggregate loss. It can be non-Markovian, like in the paper by Gizeki and Goldberg, where they introduced some self-inciting process related to the Hawkes process. ACD means auto-regressive conditional duration. So this kind of models have been, for instance, studied by econometricians like Bob Engel. But still we have an important feature, that is, even if they are non-Markovian, the loss intensity only depends upon past losses. So in some sense, there's nothing that is exogenous to the dynamics of the losses. So one very, I would say, straightforward question is, can we go back from the dynamic of a large portfolio, of the aggregate loss, to the individual names? And it can be seen, for instance, that since everything depends only upon the aggregate loss, then in order to be self-consistent, the only individual models or name-per-name models that are consistent with such models are models with individual intensities that are all equal, that is, homogeneous models. So obviously we have here an issue, which is to find a name-per-name model which is really fully consistent with the stated dynamics of the aggregate loss, which is Markovian or which involves a very small dimension. We must have some very stringent restriction on the dynamics of the credit spreads. So, well, there are lots of models. So what might we do? So there is, just to mention that there is a very simple approach that might be used, and I think it should be used, basically, which is, now we have some historical data on liquid tranches. We have also, for instance, some historical data on index credit spread. So we could, since we are able to compute the change in the PV of CDO tranche on an historical perspective, we strive to relate through some kind of regression analysis the changes in the PV of tranches with respect to the change in the changes in the spread of the index. Also, we should also backtest the hedging performance of different models. So this is similar to what has been doing in equity derivatives markets, and I guess that there are various investment banks which have developed some backtesters. It relies a lot on the quality of the data, which is, I think, which may be a critical issue. Market has not been so liquid at all times. It requires some rather clean historical database, but now we could, in some sense, look at from the market what is the implied hedge ratios that are optimal. So let us, apart from this rather econometric approach, let us go back to the different models and how we can deal with risk management. So in the case of a structural model, in the simplest case of a Black-Cox framework where the asset prices follow log normal process, then we can perfectly hedge the CDS and we can perfectly hedge a CDO tranche. Basically, defaults are predictable. There is only one kind of risk, which is credit spread risk or asset price risk. And stock prices and credit spreads are perfectly correlated in that framework, and we have complete markets. So it's more like now an equity derivatives product than a credit product. So of course, in some sense, it's appealing, but obviously we have some, let's say, does not seem very realistic. If we look at the multivariate Poisson model, who actually have some nice features, but if we look at the hedging within this kind of models, since we have a possibility of simultaneous defaults, if we think of n names, now we can see that we have some positive probabilities for 2 at the power n states of the world. And we have only n hedging instruments, let's say n plus 1 with a risk-free asset. So there is a very high degree of default risk incompleteness there. Intensities are deterministic between 2 shocks. And so it's not really, there is no really any credit spread risk there. And the default risk incompleteness is very large. So it seems very difficult to have a satisfactory hedging strategy. One interesting framework is the copula and the contingent models, the interacting intensity models. So I will firstly look at the theory very briefly and look at how the traders and the practitioners deal with these models. So we can see there that the default intensities in these models are only related to past defaults. And in some sense, the credit spread risk, it's quite clear in the Jaro NU framework, derives from default risk. If the copula is smooth, and since the intensities are related to partial derivatives of the copula, it can be proved that there are no simultaneous defaults. So here we have contingent, but no simultaneous defaults. But since everything is, so I do not provide a formal proof, but since there is no true credit spread risk, because credit spread risk is derived from default risk, we are in a complete markets framework. The mathematics are rather involved and are related to representation theorems for multivariate point processes. So there is some people that are currently working on these issues. So it's a bit striking because if you look at the copula model, the theory says we do not have to care about credit spread risk. We only have to care about default risk. And default risk could be perfectly hedged in that framework. So if we look at the practice, it's quite different because the focus is on the credit spread risk only. And I had the feeling that traders were more or less controlling a posteriori, having some ex post control of default risk and looking what would arise in case of default of some names. But really the main focus is on credit risk. So the idea is that what people do is that they have some copula model, they compute some CDS edge ratio by bumping the marginal credit curves, they compute the CDO price increment, and then they derive a portfolio of CDS such that we have a local edge with respect to some small shift in the credit spread curves. So this is a local sensitivity analysis. It is quite model dependent. It will depend on the copula that will be used. There is no guarantee that this kind of local edging approach leads to a correct global edge. And one very important thing is we are not sure at all that the gamma effects will offset the theta effects, as is, for instance, the case in the Black-Scholes model. So I would like here to introduce some two concepts that I think some people are familiar with, which are the parallel and idiosyncratic gammas. So I've taken a very simple case of a homogeneous portfolio. In that case, the gamma matrix, it's the matrix of the second derivatives of a PV of a CDO tranche with respect to credit spread, has that kind of structure. So we have some diagonal terms equal to capital I, and some of diagonal terms equal to B. I denote by S1, Sn the change in the credit spreads. And I assume that we have already some first order edge with CDS, so I'm going only to consider the second order effect. So let us assume that we have just a change in the credit spread of name 1. So we can see that the PV of a tranche will only involve the diagonal term, capital I, times the square of the change in the credit spread. Now assume a parallel shift in credit spreads. It can be seen now that the change in the PV is proportional to that quantity, I plus n minus 1 times B, which is called the parallel gamma. And the previous effect is called the idiosyncratic gamma. It's the only quantities that are involved, so we can simplify the second order analysis by just two quantities that are this idiosyncratic and parallel gamma. If we go on with some homogeneous portfolio, we could think of the credit spread covariance matrix having that form. And now we can compute the expected gamma PNL, which should be offset by some theta. And the simple computations leads to this, which shows here that we have two effects. We have one effect which is related to the idiosyncratic gamma. Here we have a parallel gamma, and we have a correlation between credit spreads. We can see here that we have a rather high spread correlation sensitivities, at least for large portfolios, thanks to the n times b times rho term. When the rho is equal to 1, credit spreads are perfectly correlated, and we have only parallel gamma. We have no notion of idiosyncratic gamma. So it can be seen that if we apply this, for instance, to the pricing of an equity tranche, that the idiosyncratic gamma effect will be quite important when considering, for instance, the equity tranche. So what people do in the market is slightly more sophisticated. They also use that Bayes correlation approach. For instance, if we look at the hedging of tranchelets on standard indices or bespoke portfolios, what do we have? We have that the correlation in the Gaussian copula will depend on the expected loss of a tranche. So it means now that we have a shift in credit spreads that will change both the marginal credit curves and the implied correlation parameter, and we have a notion of a sticky delta that is the total derivative of a PV with respect to the credit curve. But I think that the main point is that the focus is really still on the credit spread hedging. People do not seem to care so much about the default hedge. We can still talk about idiosyncratic gamma that is related to the dispersion risk between credit spreads and the parallel spread risk. So there is a category of rather new and appealing models that, instead of looking at the name per name approach, concentrate upon the dynamic of aggregate loss. So I was mentioning there is no notion of idiosyncratic gamma in such model. In some sense, individual credit spreads, though it's not stated explicitly in the model, are to be perfectly correlated if you want to have a name per name approach. We have some jumps in the aggregate loss process related to default risk. So we can deal with default risk, and we can deal with parallel gamma that are related to change in loss intensity. The aggregate loss intensity is the sum of the individual intensities. Since all the individual intensities are equal, then a change in the loss intensity, aggregate loss intensity, is like a shift, common shift in all credit spreads. So there is an issue which, what should be the hedging instrument for CDO tranche? Should it be the index, or should we have different edge ratios for different names? If we were to edge an equity tranche with an aggregate loss model, I think it can become very problematic because we have a very high sensitivity to the heterogeneity between credit spreads, which is not taken really into account in the aggregate loss. And for instance, it's quite likely that the edge ratios for riskier names are likely to be higher. So if we have a General Motors name in an equity tranche at some time, and we are in an aggregate loss model, edging with the index, we are likely to perform rather poorly. So this is related to the fact that though they have some appealing features, these models basically have some difficulties, at least in my point of view, in dealing with the idiosyncratic gamma. There is another, so there are actually many approaches. Just briefly to mention one other useful, possibly useful approach, which would be to edge CDO tranches with liquid tranches. For instance, with either, for instance, edging tranchelettes on I-tracks with the tranches using the standard attachment and detachment points. So here the framework is different because up to now I was dealing with edging the CDO tranche with CDS, and now I'm considering the edging of the CDO tranche with other CDO tranches. So I will be very brief there. We can think of using some kind of a perfect copula. I have a slight adjustment in the Ellen White paper. They use a quadratic criteria. I've been considering some entropic criteria. So the idea here is to try to specify a conditional default probability distribution that will allow a perfect matching to liquid tranches. So these are the consistency constraints. And it is actually possible to derive such density. The expression is there. The lambdas are the Lagrange multiplier in the optimization problem associated with these consistency constraints. And it is rather, I will not write the mathematics, but it's rather easy to compute the derivatives of the tranchelet with respect to the prices of the liquid tranches. So we can actually compute some edge ratios of the tranchelet with respect to the liquid tranches. So now that was the end of my global journey in that realm of risk management, and I will briefly give a flavor of the technical notes that have been distributed. So as we've just seen, when dealing with the risk management of CDOs, traders seems to be more focused on credit spread and correlation risk rather than default risk. And this is not, it can be surprising at first sight because we could think that default risk, the magnitude of default risk is much larger than the magnitude of credit spread risk. But if you look, for instance, at a large index, if there is default of one name, it will lead maybe to a jump of 0.4% on the aggregate loss, which is a rather small jump, even compared to equity markets. So we could say that, and the larger the portfolio, the smaller will be the jump in the aggregate loss due to individual defaults. In the limit, there will be no jump at all if we think of a large portfolio approximation, then the path of the aggregate loss will become continuous. So the framework that is described in the paper is that we are given some probability Q, which is equivalent to the historical probability P, such that defaultable prices are martingales, and default times follow multivariate Koch process. So in that framework, and also that risk premiums are bounded. So in that framework, what we have is basically we have no contingent, and we have So it means that at default times, credit spreads of survival names do not jump, and we do not have simultaneous defaults either. So just a few words about the technical background. So the idea is to make some kind of projection, some conditional expectations of the default indicators onto the information generated by the credit spreads. And to do the same, so we have some kind of smooth projection of the aggregate loss. An aggregate loss from the observation of credit spreads only, and in some sense not observing the default events. So we have some kind of incomplete information. So we have some kind of pseudo market where only credit spreads are observed. So in that market, by construction, we have only credit spread risk and not default risk. So to make things more clear, let us assume that credit spreads follow multivariate Cox-Ingersoll-Ross process, which is a framework similar to interest rates. So there are different steps in the approach. Step one is to approximate the CDO tranche payoff, that is, we replace the actual aggregate loss by its smooth projection on credit spreads. The step two is to consider some pseudo CDS that are not actually traded in the market, which correspond to the projection of the CDS dynamics onto the credit spread filtration. So this is very similar to some other to some concepts that have already been discussed in the financial mathematics literature, that corresponds to the idea of well-diversified portfolios. In some sense, for instance, the infinitely granular portfolio is not a portfolio that you can trade in, and will be typically a well-diversified portfolio. Here, the idea is that we have some kind of diversification of default risk of CDS at a name level. That is, if I have, for instance, to consider some CDS on, on BNP Paribas, then I would split that CDS in a portfolio of K CDS. All the individual characteristics will be similar to that of the CDS on BNP Paribas, but with some kind of independence between the smaller CDS. And we have thus replaced the, let's say, the jumpy CDS by a smooth CDS. So we have some kind of shadow market that only involves credit spread risk. So the nice thing is that the shadow market is complete, and in my example is Markovian. So in that shadow market, I can compute perfect edge ratios with respect to pseudo CDS. So there are some technicalities that I do not discuss there. And so there is a theoretical edge, since we are now in a complete market for a pseudo or smooth payoff with some pseudo smooth underlying assets. Well, so this is, up to now, this is quite theoretical. But now, so the hedging strategy is adapted with respect to the credit spread. We depend only on the credit spread information, not on defaults. And I will apply this hedging strategy to buying protection with a true CDS. So the point is that now I'm constructing a strategy that is not in that shadow pseudo market, but which deals with actual hedging instruments. And I'm going to consider the hedging error when applying that hedging strategy to the actual payoff of a true CDO tranche. And the striking result is that we can bound the hedging error. So here we have constructed a hedging strategy, which for large number of names will lead to an hedging error which tends towards zero. So the idea behind this is that the hedging error increases with the number of names. So the proof is rather mathematically involved. It's not very difficult for those who are used with stochastic calculus, but it's an exercise in stochastic calculus, let's say. But the economic idea is that we have diversification of default risk at the portfolio level, and thus we can only focus on the remaining risk, that is the credit spread risk. So, up to my knowledge, we have thus provided some hedging technique for CDO tranche with some non-theoretical properties. We can control the hedging error. This holds in intensity models. It takes into account both idiosyncratic and parallel gamma risk. So we can take into account both shifts, parallel shifts in credit spreads and specific changes in credit spreads. It relies on the assumption of no simultaneous defaults, no contagion effect assumptions. The important point of the contagion, since we have no contagion, we can actually diversify the default risk, because basically the credit spreads are more or less orthogonal to default risk. So this is very important. If you believe that there is some contagion in the credit markets, then all the results no longer hold, and the hedging is more involved. So there is a lot. So the note is quite theoretical at that stage. I have no empirical results. So there is rather a number of practical work to do. In some sense, well, it is not designed to be applied directly. For instance, if I were to hedge an equity tranche, I will obviously not forget about default risk. And I would not consider that iTrax or CDX first losses as smooth. But I would maybe use that kind of idea and also look at the actual default risk in the strategy. So as to conclude, that's my last slide. Here we have a framework where we can provide some link between the pricing and the hedging and try to not to dig the black hole in CDO modeling, but to try to give some ideas to relate the price of a CDO tranche to the cost of the hedge, and to provide some hedging strategies that at least within some model framework, where these intensity models should behave correctly. And the idea is really a mixing of dynamic hedging strategy for the credit spread risk and more insurance ideas for hedging or dealing with the default risk. So that's all for my talk.
Thank you, Jean-Paul, for this stimulating presentation, and which gives us also an overview of the state of the art in pricing and hedging credit correlation products. I have one, before opening the floor to question, I have one question which is also a comment. It's no secret for anyone here that all the banks are struggling to come up with a good model to price and hedge credit correlation products. And currently we have two competing frameworks for pricing CDOs. You have the bottom-up approach, where you model single names and you model default correlations through copulas. The problem we have with this approach is it remains a static framework, which is not appropriate to price products like forward-starting CDOs or option on CDO tranches. So to address those shortcomings, people have been proposing this top-down approach where you directly model the aggregate loss function. But as you said, they assume a Markov process for the aggregate loss function, which implies that the intensities are perfectly correlated. So if you follow this approach, you would just use the index or the underlying portfolio to hedge your risk. So the question I have is, listening to your presentation, it seemed that we should drop the top-down approach and go back to the bottom-up approach, and along the line that you described in your paper, because that's the only approach which allows you to model two things. One is a change in the dispersion of spreads, what traders refer to as gamma risk, and contagion, i.e. when there is a default on a name, it impacts the credit spread of the other names. And am I right, or how do you react to my comments?
I think that first of all, I think that the aggregate loss models were not designed firstly for hedging issues, but more like a rather simple route to price some for starting CDOs, products that would be path dependent on the loss. But in some sense, the intensity model could do almost the same job. It's a bit funny that we are being hosted by Merrill Lynch, because I think 1 week ago there was a paper posted by some researchers of Merrill Lynch about the implementation, the use of some intensity model.
Can I ask Alex to comment on that?
Yes. So in some sense, I would say that of course, there are some technicalities, but if we can improve the implementation of the intensity model, deal with the numerical issue, the large dimension, and so on, in some sense, we have a rather nice framework, because, well, there's the issue that the model will not maybe be perfectly calibrated on the correlation skews, but we can deal with a rather large number of risks, on credit spread risks and default risk. The only issue, in my view, is that it's difficult at the moment to introduce properly some contingent effects, and meanwhile having some model that is tractable. So if some trader or some financial institution strongly believes that the contingent is some major feature in the credit market, then we do not have that feature in an intensity model, so that might be a problem.
Yeah.
But the aggregate loss model, if we try to use that framework and go into the hedging direction, that was not done firstly, we have really the big issue that we do not properly deal with dispersion of spread. So if we are to, let's say, risk manage a senior tranche, that may not be such a big issue, but for first losses, I think it's really a big drawback.
Thank you. A question? Yeah, here.
Yeah, I got the impression from your talk that you were sort of indicating that aggregate loss techniques were relatively new. When I looked at, like back in the late 90s, Duffy and Singleton came up with this idea of simulating first to default by noting that the sum of the default intensities is the intensity associated with first to default. In fact, they built a model that I believe is basically each intensity is stochastic and follows a mean reverting jump process, which also has a lot of analytical tractability at the marginal distribution level, so you could calibrate it to default swaps very easily. And I think that through that, you could probably price tranches and compute hedge ratios. And also, by putting correlation on the jump diffusion, you can actually get the correlation of the credit spreads as well as default correlation. So I don't know if you've looked at that. I don't even know if that paper was
Are
published.
you referring to Duffy and Galliano?
No, Duffy
No.
and Singleton was
Singleton.
written, I think, like
Yeah.
in 1999.
Yeah. There's actually, well, there are several papers by Duffy and Singleton, but in one of the papers, they more or less consider the loss intensity as being the sum of the individual intensities, and that in some sense, when doing some Monte Carlo simulation, that's probably the best way to do some Monte Carlo simulation, because that is to simulate the next default time, that is the first default time, and then decide which will be the name in default, so that's much more efficient. The point is that in the Duffy and Singleton paper, so they describe a pricing procedure. From that, you can compute, at least theoretically, you can compute some sensitivities with respect to shift in credit spreads. And there is also default risk. The point is that there is no connection in between the hedging strategy and the price. So the core of they start by specifying a risk neutral pricing probability, which has actually nice features, but there is nothing which connects that probability to the historical probability, and nothing that connects the cost of the hedge to the price. So what I've been showing in the paper is that at least if we have a well-diversified portfolio and some options on these well-diversified portfolios, the market asymptotically becomes complete